Right, traders, welcome back to the channel. Here we have the US 500 or the S&P 500 chart in front of us. I'm going to be going over a quick case study from a trade that could have been taken, or that trade that I did take myself on last week on Friday. So time of recording this is Monday the 27th, right? So again, this is the 15-minute time frame. So again, Thursday we saw a very large movement to the downside. So again, let's quickly reverse a step and look at our overall market structure, right? So again, the way that I am looking at market structure personally on the S&P 500 is that we had price giving us a structural high, structural low. Then from here, we saw price give a structural high all the way up here, right? So this is our breaker structure to the upside. Let's label that as breaker structure, right? So those who've watched my videos for a long time understand the way that I look at the market from essentially the systematic way to break it down from an SMC ICT perspective, right? So the things that I look at, the first thing I look at is market structure, looking at the market structure and understanding where the highs and lows are in the market itself. So now that we've had a breaker structure to the upside, Thursday's move, Thursday the 23rd of May, gave us a structural break to the downside. So we've seen a breaker structure to the downside over here. So now from here, what we do is we have a bearish dealing range to currently work with, right? We have a bearish dealing range, and that leads on to the second thing, right? So we have a structural high, which is up here, and we have a structural low, which is down here, right? And the dealing range itself, the bearish dealing range, is the second thing we look at when it comes to determining a bias, right? We look at the dealing range, okay? So what does the dealing range itself tell us? Well, the dealing range very simply gives us the projection from the swing high down to the swing low, right? So the swing high is up here and the swing low is down here. So the third thing we look at is we look at our premium and discount arrays, right? PD arrays. And the last thing we look at is our fair value gap. So let's quickly type that in. So PD arrays and fair value gaps. Okay, so PD arrays and fair value gaps. So these are the four most important and fundamental things to understanding how to build a bias, right? So from here, we simply project the Fibonacci tool from the swing high down to the swing low, just like this. So swing high down to the swing low like this, right? So let's zoom in on the charts again. And now from here, we identify areas of inefficiency or fair value gaps in price, okay? So the first fair value gap here, it's quite easy to see where the inefficiencies are. So what we have is we have a fair value gap that's produced itself just over here, and we had another fair value gap produce itself just over here. Now the thing to bear in mind is notice how both of these fair value gaps, this top one and this bottom one, both lie above the equilibrium. So both of these lie in a premium. Very important to understand that, right? So we understand both of these lie in a premium. And when things lie in a premium, right, we understand that from an interbank price delivery algorithm perspective, right? When we talk about the IPDA, the interbank price delivery algorithm seeks three things. I apologize. The first thing is liquidity. The second thing is fair value gaps. And the third thing it seeks is it wants to move from a premium to a discount, or in this particular case study, a discount up to a premium. Very important to understand. Premium to discount, discount back up to premium. So these are the most fundamental driving factors of the interbank price delivery algorithm, okay? So once we've established this, what we need to understand is that on Friday, the markets presented a buy trade to us from the discounted range, So let's now go down to the 5-minute time frame and see how you could have potentially got involved in this trade, right? So again, what we have over here is we have price begin by giving us the Asian session range, right? So let's dissect price action systematically. So what we have over here is we have the Asian session range. So the Asian range itself starts at 19 o'clock Eastern Standard Time, and it ends at 5 a.m. UK time, which is equivalent to New York midnight opening price. So this here is the Asian session range, okay? This is what we call the Asian session range, all right? What do we mean by the Asian session range? Well, the Asian session is just a time-based liquidity pool that we look for manipulation of sorts, right? So this is our Asian session, which I've labeled here in orange, okay? So in the London session, what do we see, right? This is no accident, right? When price sweeps liquidity pools day in and day out to such an extreme level of accuracy, you have to ask yourself why. what is the purpose of this down move over here? What does price look to achieve with this particular price action region? What does price achieve by doing this, right? What does this occur? This occurs why? Well, the simple answer is this traps sellers, or it entices sellers, right? So sellers are enticed here. Sellers get enticed to the market here in this particular region, right? So when we see sellers enticed here, what this represents is it represents buy side liquidity being engineered in and around this level, right? So we have the Asian range low and we have the Asian range high over here. But we want to understand the market sweeps the Asian range low and it creates what we call the ICT Judas swing. And what is the Judas swing? The Judas swing is simply a manipulation, right? So if we label this here, the Judas swing or the manipulation, some people call it the turtle soup. All of these names are valid. It's simply a manipulation or a Judas swing or a turtle soup, right? It's essentially trapping traders onto the other side of the market before we take advantage. So after we've had an accumulation and a manipulation, what we look for now is a distribution, right? We want to understand, we want to wait for the markets to open. So again, 9:30 Eastern time. So you want to ask yourself, where is the 9:30 Eastern time? The 9:30 Eastern time is equivalent to 14:30 UK time. So this line over here in red represents the market open, right? This is the 9:30 equities and indices open. This is 9:30 Eastern time, right? This line over here, 9:30 Eastern time. Okay, so this is, let's label that as 9:30 Eastern Standard Time, right? So from here, you want to ask yourself, what are we going to look for? What are we going to look for? So you understand that we're in the discount, and we're aiming for premium. So from here, we want to be looking for a bullish fair value gap that supports the narrative. So what we have over here is we have price very clearly breaking structure to the upside. So we have an impulsive move to the upside itself, right? So again, what we have is we have an impulsive move from this swing low up to this swing high over here. This swing low up to this swing high. This is the dealing range within the New York session, the 5-minute dealing range, okay? So once we have a 5-minute dealing range, what do you want to consider? Okay, with the 5-minute dealing range, what you're looking to do is you're looking to buy from a discount in this range off a fair value gap. And where are the fair value gaps in price, right? So what we see over here is we see a fair value gap, a time-based fair value gap specifically, right? So what we see over here is we see a fair value gap. That's the first thing. We see a fair value gap. You want to notice the time in which the fair value gap occurs, which is very important. What time does this fair value gap occur? Very important. So it needs to occur after 9:30 Eastern time, but before 11 a.m. Eastern time, because these are the prime times to trade the S&P 500, the Nasdaq, the US 30, even the Forex pairs, right? 9:30 a.m. to 11:30 or even 11, Eastern time. a.m. Eastern time is the correct time to trade, right? So you want to be trading from 9:30 to 11 a.m. Eastern Standard Time. Very important. And this particular fair value gap presented at 10:50. So it's well within that range of 9:30 to 11 a.m., right? The next thing to understand is that once we've established our dealing range after a break of structure, right, it's important to understand that price comes into a discount. So you want to be buying at the equilibrium or slightly below the equilibrium. These are where high probability order blocks are formed. The most important thing is time. And afterwards, it's discounted bullish fair value gaps, okay? Discounted bullish fair value gaps. So very simply, you take the candle just before the inefficiency. So I often get a lot of students asking me, liquid effects, where is the order block? How do I identify the order block? Well, it's quite simply the candle over here before the majority of the inefficiency, right? So from here, this is our 5-minute order block, right? So let's quickly label that as an M5 bullish OB. Okay, this is an M5 or a 5-minute bullish order block, and simply because it breaks structure, it leaves a fair value gap. It's priced in the discount in our time zone, right? Our 9:30 a.m. to 11 a.m. Eastern Standard Time, which is very important. Notice how we're priced in an M15 discount. And from here, our job now is to aim for a premium, an M15 premium, which we have done over here, right? Price reached into a premium later on, right? So from here, we see price mitigate this level. Again, stop loss, just below. I would keep it just below the dealing range itself. And from here, where do we look to target, right? We look to target this fair value gap over here to the left, right? So this was a quick scalp of the S&P 500, a particular trade that you could have taken, just shy of a 1.5 hour trade, 1.3 hour trade, but it's simply following the basic rules of an M5 order block, accumulation, manipulation, and distribution into the M15 premium level.